Yeah, for sure. So, hey, I'm with Tyler Heymann from Prism Financial, and Tyler is going to tell us today all about, investing in, say, stocks versus real estate. You guys are the stock people. You guys totally help with wealth advising and planning and that type of thing. And when you and I sat down and we talked about, the benefits of stocks versus real estate, you had a really good, synopsis of, for me specifically, what we've done and now how we should diversify. So when you talk to somebody and you say, what's the difference between stock investing versus real estate investing over time, what do you show them?
Sure. So, for anybody that's investing, especially when you have perhaps a smaller bucket of money, and you'd asked about military. So let's take military with a pension amount of $2,500 a month, let's say.
Okay.
And maybe a pool of savings over here of, $50,000.
Okay.
Right? If you invest the $50,000 into stocks, let's say, and you get a 7.2% return.
Okay, and is that what the average, or what is that right now?
That's a simple rule of 72 number. If you get 7.2% return, your money's going to double every 10 years.
Okay, so that's the rule of 72.
The rule of 72.
Okay.
So in 10 years, your $50,000 is going to become $100,000.
Okay.
Okay? That's investing in stocks. Now, if you have $50,000, you might want to and be able to do that.
Yeah.
Right? Let's take the same $50,000 and put it into a real estate investment as a down payment.
Okay.
So we put $50,000 in. How much of an asset can we control? What value of a home or a piece of real estate can we control typically for $50,000?
I'd say right now we're probably at like $250,000.
Okay. So our asset value is $250.
You know what? No, let's go to just $200.
All right.
Yeah, because that means somebody had been put 25% down.
All right. So we've got a $200,000 asset value. We have $50,000 of equity in the house.
Okay.
Which means we've borrowed. So this is asset value. And this is going to be our mortgage, which is $150K.
Okay.
All right, so 10 years passes. And what's the average appreciation of the homes that you want to use?
Like 4%. 4%.
4%, okay.
Yeah, the national average over the last 20 years was like 4 and change.
Okay. So what's growing at 4%? The 50 or the 200?
What's growing is the 200.
200, right?
Right.
So I'm not using my HP12C here, but we're going to estimate this and call this a future value. It's not going to be 400,000, but let's call it 325 will be conservative here.
Okay.
Is the new future value. Now, you put in 50,000. Your current asset price is 325.
Okay.
What happened to the mortgage over that time period?
Yes, they were buying it down the first few years. They were really paying a lot of interest, so that 150 probably went down to what do you think, like 120?
Sure, 10 years?
Yeah.
Maybe even a little bit less, but let's call it 120.
Okay.
Assuming you didn't refinance and assuming that you didn't pay the mortgage, let's assume that they had a renter in there.
Okay.
They paid the mortgage. There was no cash flow.
All right.
Right? They just covered the mortgage.
Oh, yeah, so like a break even.
Break even.
Okay.
So the math here is 325,000 of asset value minus the 120 gives us 205,000 of equity in the house. Now there's some selling commissions and some cost, but what you basically did there was you took the same $50,000 and you turned it into 205,000 with a lower return over the same period of time as getting a 7.2% over 10 years on the same amount of money invested.
Wow. And you know what's crazy is that's not taking into account that the person probably cash flowed that at least a little bit. They're able to write off, the tax portion of it as well, right? From the tax perspective, what happens if they were to, that's a whole other video. But the tax benefits from it. Everyone benefits at least a little bit from the tax benefits of real estate, but some more than others.
Above this line, there's not a lot of tax benefits here.
Okay.
Taxes, I'm going to take that back.
Okay.
Taxes are a whole other level of complexity.
Yes.
There is quite often a chance that below the line, there are some very meaningful tax benefits up to a certain level for many investors.
Okay.
Right? You have to consult your tax practitioner to find out whether the real estate you own is going to provide you tax benefits and exactly what they look like. But more often than not, there is the potential for tax benefits in real estate.
Dig it.
Right? So if the income's high enough and your number of properties is low enough and your depreciation schedules and everything work out to some sort of an economic paper loss,
Right.
And you can use the deduction, then you can oftentimes see some tax benefits from the ownership of real estate. Whereas with stocks, there are typically not the same kinds of tax benefits.
That was really lawyer-esque, dude. That was like, maybe.
You got to. I mean, look, at the end of the day, people hire me because I take a fiduciary role in their lives and I give them advice as if I was giving it to myself.
Totally, brother.
And I'm liable for everything that I say. So.
No, I appreciate that. Hey, that's why we hired you.
All right, but the bottom line here is that assuming you can get this return and even a break-even cash flow, if everything goes well with real estate, you're controlling a larger asset
Okay.
with the same amount of money as up here. Now, there are some risks.
Okay.
Right? Real estate has a whole myriad of different risks that stocks may or may not. It's much less transparent market.
Okay.
Right? It's much less liquid.
Right.
There are, there's a lot of opportunity in lease-up risk, which is why people hire you.
Right.
Right, to manage the property. And it oftentimes can take some work to do this, which is, again, another reason people hire you. So, go in with eyes wide open, but if you do it right, hopefully you're seeing the power, the potential of the real estate ownership versus other investments, which is why I like real estate. I think it's a great place to go for a lot of people.
Nice, dude. I dig it. Thanks for sharing, brother.